Hi, and welcome to the September 2017 Downtown Pittsburgh IBD Meetup presentation. My name is Eric Rossi. I'm a co-organizer of this meetup group. And if you found this video on YouTube and you're not familiar with the meetup group, you can use this link to join the meetup group and see all the past meetings we've had and get other information about the group. So the mission of this group is to educate individual investors about the CAN-SLIM investing strategy. So this means identifying the best material available, whether it be from books, magazines, articles, webinars, videos, etc. And this presentation is for educational purposes only. I'm not making any recommendations to buy or sell stocks. Investing in stocks carries substantial risk and you can lose your capital. I'm a non-professional volunteer investor. Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily, Inc. MarketSmith is a registered trademark of MarketSmith, Inc. And Meetup is a registered trademark of Meetup, Inc. So prerequisite, this video assumes that the viewer is familiar with the CAN-SLIM investing strategy developed by Investors Business Daily. And at a minimum, viewers should read this book, How to Make Money in Stocks, by William J. O'Neill before viewing this video. If you haven't read this book or you're not familiar with CAN-SLIM, you're certainly welcome to listen, and I'm sure you'll learn something, but you'll gain a lot more from this if you've got a basic understanding of the CAN-SLIM investing strategy. So here's the topics for this month. The first one, I have a new market dashboard I'm going to show that just been reflecting on what was in the dashboard previously and how well was it really, not so much predicting, because I'm never trying to predict where the market's going to head, but how relevant was it to really show when the market was high risk versus low risk versus medium risk. So I think this new version does a better job of capturing that, and hopefully it'll be more useful to everyone watching this. The second part is a special for this month. I call it Think and Grow Rich Trading. And this is basically how to apply the concepts from a famous book called Think and Grow Rich by Napoleon Hill. And I'm going to talk about how it's relevant to trading. Then we'll do a market analysis. We'll talk about current holdings. Again, these are my current holdings just as examples, and my current watch list as an example, and then we'll conclude. So here's the new market dashboard, and if you've been following this for a while, you'll see some new things here. And the first few things I added here was, when was the last NASDAQ correction that was greater than 5%, greater than 10%, and greater than 20%? Now, these time frames here, I'm going to be adjusting these as time goes on. But this is an initial shot at this just based on experience and watching the market for a long time now. And what I'm getting at here, but the reason to look at this is that when the market is correcting and then it comes out of that correction, that's often when growth stocks will be breaking out of bases, and that is generally a great time to buy stocks with the CAN-SLIM strategy. So when the market is correcting is actually the time it's easy to walk away from the market and want to not pay attention, but it's actually a time to pay attention more than ever and keep your watch list up to date and keep watching stocks and be ready to buy, because when the market corrects and starts coming out of it, that tends to be when stocks make their bigger moves. So if you look at this right now, it's not very favorable. We've got the last 5% correction in the NASDAQ happened right before the election of last year. So we're going on about a year now without even a 5% correction. And there's an investor that I really like. His name is Mark Minervini. And if you follow him on StockTwits, he shows he posts information like this as well. And I know he recently posted something that the time frame we've gone without a 5% correction is one of the longest in history. So in theory, we're overdue for a correction here, and not having a recent correction means that lately the market's been very choppy, and I was hoping we would have a correction there, but it didn't quite reach 5%. And if you look at these other indicators too, we haven't had a 10% correction since February of 2016. So we're going on almost 2 years, and we haven't had a 20% correction since 2011. So this is all indication that while the market's been performing, if you look at the year to date, the market is performing well this year, but as of right now, this moment in time, it would be nice to have a little correction and have the market settle down a little bit so that stocks can set up into new bases. Now, stocks can certainly still set up in bases even when we haven't had a correction in this long, but it just makes it not as many. Stocks kind of do their own thing then. They're not following the tide of the market, and it just means that right now what I'm generally seeing is that stocks are tending to form bases at different times, and they're not all forming around the same time, which is generally what happens when the market has a correction. So these all get a red because we've gone so long here without any type of correction. Okay, the next thing I added here is the NASDAQ chart pattern. So if the NASDAQ is basing, as I'm saying here, or consolidating, that means it's going to be a good time soon to potentially buy once it starts coming out of that correction or that base. And for right now, I said that the NASDAQ is slightly extended. It had a recent consolidation that we'll look at later, and it's a little extended from there, so I'm going to give it a yellow. Red would be when the NASDAQ is correcting, not necessarily in a base. So again, I'm going to keep working on this stuff here. This was just a first crack at this. This is going to evolve over time, but I think this is a little more indicative of my goal here really is to have green indicators when it's a good time to buy stocks. So you can see if the NASDAQ's going up and up and up, and then we have this 20%-ish correction, I really want these indicators to be going green. And you can see that within the first couple weeks of coming out of a correction, I'm going to be getting green indicators here. I'm going to be getting a green here that it's basing or consolidating. It's no longer correcting. It's coming up and finishing a base. And it's going to be, on this one, I'm not going to get a green till it comes above the 50-day moving average, but I'll start getting greens here when the market is in this area here, which, in my opinion, is where the best opportunities lie. And the idea here with the NASDAQ relative to the 50-day moving average, I've noticed over the past couple years that when the NASDAQ gets around 4 to 5% above the 50-day moving average, it tends to be a temporary top. So you can see here, if it's below the 50-day moving average, I'm going to give this a red, and if it's more than 4% above the 50-day moving average, I'm going to get a red. And you can see we're getting close here. We're 3.2% as of this video. So we're getting a little extended, which feeds into this one up here. So this, I'm giving a yellow for right now. So hopefully this will be a little more useful, this market dashboard, than the one previously. Because frankly, I found that when IBD puts the market into a confirmed uptrend, doesn't necessarily mean that it's a great time to buy. And when IBD tends to say the market's in a correction, which it hasn't done in a very long time, tends to actually be a really good time to be looking at buying, and it's not a good time to be necessarily selling shares and walking away. Okay, and these long-term indicators are the same as they've been. So we recently had, this year we've had 3 interest rate increases by the Fed, and there's 3 more expected in 2018. I need to check this actually, if there was one more. I feel like there was one more maybe in August or September. I'm gonna have to double check that. But anyways, rising interest rates is generally not a good thing for the market. It doesn't seem to really have affected the market over the past year, and it seems that with the election of Donald Trump, that has far outweighed any negativity that investors see in relation to rising interest rates. Who knows, though, rising interest rates, maybe investors are thinking they're getting back to levels that are more reasonable instead of being around zero, and that's actually healthy for the economy. But historically, when interest rates are rising, the market tends to not perform as well. So that was the logic behind this. And then you can see here overall, we're still in a bull market, which has been going on for a very long time here since 2009. So we're coming up on almost 9 years now. One of the longest running bull markets without a bear market, a big correction, one of the longest in history. And the last bear market ended in February 2009 from the financial crisis. So given the fact that we haven't had a bear market anytime recently, which feeds into the last time that the market had a decent correction on the prior slide, a lot of reds here. So overall, right now is you can see a lot, mostly reds and yellows. So I'm going to call this a medium to medium high risk time to be buying stocks overall. And I think that's about right given where the market is trading right now and how this year has been. So again, I'll keep tweaking this, but I think this is going to be better than the prior market dashboard. Okay, so the next part of this presentation is called Think and Grow Rich Trading. And this is a little special series where I'm going to talk about how to apply the principles from Napoleon Hill's book, Think and Grow Rich, to trading stocks. And this is what the book looks like right here. And it's my all-time favorite book, and it's really just has excellent information about how to be successful in general in life. And it's obviously written mostly around becoming wealthy and building personal wealth. So it's really relevant to trading because part of the reason that we trade is so that we can build wealth. So this book is a summary of Napoleon's findings and observations after 20 years of studying the most successful people of his time. And the person who gave him the idea for the book was actually Andrew Carnegie, but he also studied Andrew Carnegie for the book. And he also studied Henry Ford, Thomas Edison, Ralph Waldo Emerson. There were many more, even people that weren't alive in his time, that he studied, and he basically tried to find out what is it that these people are doing that's making them so successful. And he boiled it down to 13 steps to riches, as he calls them. And many of these can be applied to trading stocks. I'm not mapping them every single one here, but the majority of them. And I think you'll understand when you see them how they are relevant to trading stocks. So let's get right into it. The first step to riches in his book is called desire. And if you don't have a burning desire to really put in the work and become educated and learn from great traders, other people who've been really successful at this, then you're probably never going to be a great trader. You'll probably be an average trader at best. So number one here is that if you want to become a really great trader, to become a really great trader, you have to really desire to become one. If you're not so passionate about it, you're just doing this for a little bit of extra money on the side, and you don't really want to learn that much or devote that much time into it, you're not going to have the super performance that people like Bill O'Neill have, and Mark Minervini, and some of these other great traders of today and from the past. So the second step to riches is faith. And this is relevant here because if you don't believe you can be a successful trader, then that doubt is going to creep into your thoughts, and it's going to influence the way that you trade, and you're not going to be a successful trader. So to become a superior performing trader, you have to first have faith that you can do it. And part of my thought here is if Bill O'Neill, Mark Minervini, Dan Zanger, Jesse Livermore, if these guys could all become great traders and become wealthy, very wealthy traders and do it for a living, why not any of us? There's nothing special about them except that they put in the time to educate themselves and constantly learning and constantly trying to become better. The third step to riches is called auto-suggestion. And for this one, I'm only giving a couple bullets here. So if you want to learn more about this, I would go get a copy of Think and Grow Rich. You can get it at the library for free very easily, or on Amazon. You can get it for probably 10 or 15 bucks. So this technique is used, and you can use this to help you identify your financial goals and your trading goals. So it'll help you identify why are you even doing this at all, and what do you want to accomplish out of this. Do you want to have extra money to pay for your kids' college? Do you want to have extra money to pay off your house faster? Do you want to eventually quit your job and trade for a living, which is what I want to do? Do you want to start your own business that is like Investor's Business Daily, where you're going to teach other people to trade successfully? And this chapter about auto-suggestion goes into, there's some questions in the book that you can ask yourself to help really come up with your big reasons of why you want to do something like trading, and what you really want to become at the end. And another part of this is that once you identify your goals and write them down, you repeat them to yourself daily. And literally, you could write them on a piece of paper, keep it in your wallet, repeat the goals to yourself every day. You could do it more than one time a day if you want. And you also read your plan to achieve those goals. So by doing that, it constantly keeps this in your mind, and it constantly keeps you focused on whatever goal it is you want to achieve with trading stocks. So again, I'm only really scratching the surface here. If you really want to learn more about how to actually apply this and how to do it, the book tells you how to do it, and the chapter's not particularly long if I remember right. So it's not, you could probably read it in a half hour and understand how to apply that. The fourth step to riches, Napoleon calls specialized knowledge. And basically, the summary here is that really successful people have very specialized knowledge in certain areas. Henry Ford was very knowledgeable about manufacturing and automobiles, which were new at the time. And Rockefeller became very knowledgeable about how to drill and process oil and distribute oil. And Bill O'Neill became very specialized in trading stocks. And so if you want to become really great at something like trading stocks, you have to have a laser focus on that and acquiring that knowledge. And it's very special knowledge that probably very few people have. And if you go out and you read, if you're someone that goes out, gets Bill O'Neill's book I showed earlier, the Green Book, if you're someone who reads that and really studies it and applies it, and goes back and rereads it and tweaks your plan, and you keep doing that over and over a period of years, you're going to acquire this specialized knowledge that very, very few people have. And as a result of that, if you act on that knowledge, you're going to have better performance than the majority of people. So in stocks, performing fundamental and technical analysis is a great example of specialized skill, and that requires very specific knowledge. Most people don't know this, and it's better that way, actually, because it's really hard to learn to do this, and that is going to deter a lot of people from becoming great at it, which makes it easier for us to become great at it. And today, more than ever, we have many sources to obtain this knowledge. We've got websites like investors.com. We've got videos just like this one. We've got podcasts. We've got seminars that are offered by folks like IBD, or Mark Minervini's having a seminar soon. Books, a nearly endless supply of books nowadays about trading. Audiobooks, so you can even Bill O'Neill's book, How to Trade Stocks, is available in audiobook. It's available on audible.com, which is a subsidiary of Amazon. And so you can actually listen to this in the car. You don't even have to sit there with the book physically and read it. You could listen to it on your phone while you're working out, or you're going for a walk, or you're in the airport. So that's something that's rather unique to nowadays. It started off with cassette tapes, which weren't so portable. And then CDs were a little more portable, but still a little bit annoying. Nowadays, we can just have it digitally on our phone. Magazines and services like IBD. Okay, the fifth step to riches is imagination. And this one, I was on the fence about whether to include this or not. So I decided to leave it here. I think it's applicable to trading stocks, but not as much so as these other ones. Using your imagination and thinking up new ideas for trading and new ideas for how to improve your trading strategy and your trading plan can improve your performance. I'll just leave it at that. Basically being a creative thinker. So not necessarily doing what everyone else is doing, but thinking of ways to do things different and better. The sixth step to riches is called organized planning. This is relevant to trading stocks because every great investor has a written plan that tells them when they're going to buy, when they're going to sell, how to manage their portfolio, how to control risk, what's their routines they go through, all of those types of things. If you don't have a written plan and follow it and always be looking to ways to improve it, then it's too easy to forget something, and it's too easy to become a little lazy and not as disciplined as you need to be great at this. So if you don't have a written trading plan, create one, and it can start off very small. It could say, I'm only going to buy if a stock forms a cup with handle base, for example. That's all I'm going to buy. And I'm going to sell it when it goes up 20%. And if it goes down, I'm going to sell it for a 7% loss. You could start with a plan just like that. Very simple. And then as time goes on, you add to it. You add more sell rules. You add more bases that you might look at. And you can get as sophisticated as you want with this. So the bottom line here is create a written trading plan, review it often, make sure you follow it, and improve it when you do your post-analysis of your past trades. The seventh step to riches is decision. And this is really relevant in trading because you have to be decisive to be a good trader. You can't waddle back and forth about should I buy it, should I not. You should, when the trading day starts, you should already have your watch list in place, and you should already have an idea of when you're going to buy stocks or under what conditions you're going to sell them. So you should have that in advance, and that way during the trading day you can be decisive and just follow your rules and follow your plan. And you have to be decisive and not change your mind all the time to be a successful trader. If you're 1 week you're doing day trading, and then the next week you're doing swing trading, and then the next week you're doing long-term trading, and then you're doing options. You know, if you're always changing like that, it's going to be really hard to get great. So I'm not saying it's bad to have some variety and some diversity, but I think it's good to learn one thing very well first and get very good, very proficient at it before you move on to the next thing. And if you can't make a decision to buy one stock over another or sell one stock over another, then how will you ever succeed as a trader? Okay, last two. This one, eighth step to riches, is persistence. And the market is just, it really is brutal. And it's merciless, and it can beat down even the most experienced traders. And I know I've had years where I've taken significant losses, and so have all great traders. And if you read the stories of folks like Dan Zanger, who has the world record of portfolio return, and folks like that, all of them say they took huge losses at one point early in their careers. But the key is that they studied and they learned from those mistakes. And then they modified their plan, and then they kept persisting. And this iteration, this loop here of do, review, improve, and do again really led to them becoming consistently profitable, which is very, very rare, at least in my experience, to find people who are consistently outperforming the market. The 9 Step to Riches is called the Mastermind, and basically this says to leverage the knowledge of others and find experts in areas of your life where you want to improve. So for trading, if we apply this to trading stocks, we want to study the greatest traders. And obviously, I keep mentioning the same names. We've got Bill O'Neill, who is the founder of Investors Business Daily. So he's a great one to learn from. There's another trader who I mentioned he holds the world record right now, and his name is Dan Zanger. There's also another one, and his name is Mark Minervini. And these are all, these are just a few. There's definitely other great traders out there. There's Gil Morales, there's Chris Catcher, there's plenty more. So by studying from other people who are already great at this, we can dramatically accelerate our learning and our performance. We'll do far better than trial and error on our own. And you want to be careful where you get your advice. Only take advice from the very best people. So it's okay to take advice from a friend or a family member if they're a successful investor. If they're not, then I wouldn't take their advice. And meetup groups like this and online forums are another modern way that we have now to tap into this mastermind concept. Certainly wasn't available to Napoleon when he wrote this book. Okay, so there are more steps to riches in the book, but I think they're not so relevant to trading stocks. And in summary, thinking is hard work, but the rewards are great, particularly when it comes to trading stocks. One great way to apply thinking to trading stocks is to reflect on your past trades. Why did you buy the stock? What was your initial plan to sell it? And that means for profit and for losses. So there's both, right? Did you set a stop loss that was too large or too small? Okay, I've been doing a lot of thinking about stop losses lately and doing a lot of studying of my trades for the year and come to the conclusion that I'm keeping too small of a stop, and it's stopping me out too soon, and as a result I'm missing out on some big profits later. So that's one example of thinking about and studying your past trades and coming to conclusions about what you're doing well and what can you do better. Why did you sell the stock? Did you sell it at the right time? Did you sell it too early or too late? And what could you have done differently to improve the trade? So these are just a few questions you can ask yourself to think about your trades and hopefully grow rich as a result of it. Okay, I'm going to switch over to MarketSmith now and we'll do a market analysis. And then I'll show them, these are my current holdings: Microchip, Applied Materials, Square, Stamps.com, and Netflix. I'll go over some watch list stocks that are listed here. And then we'll come back and finish the presentation. All right, so let's start with current positions. So Microchip recently broke out of this cup with handle base, and you can see here that it had a decent breakout here. You can see that there was after the breakout day, there was another day of accumulation, although volume was low. And then you can see afterwards, you can see this thing after breaking out of the buy point here, it really only tested it one more time right here. and it's been just steadily going up. This is a nice, slow, easy one to hold for right now. It's following a pretty nice trend. It's not wild. It's not very volatile. It's up 7% in 5 weeks, so that's not a huge gainer by any means, but it's moving up nicely, and got another month until earnings. You can see earnings growth and sales growth is really good, very consistent, which is nice. And this was only technically a first stage base. So granted, the stock, since around this point when it kind of broke out of this long period here at 52, it hasn't quite doubled from there, but almost. But you can see it has a tendency of making a base and then moving up a little bit and then forming another one. It doesn't have a tendency of it's not very volatile. It's very steady, and it has a tendency of moving up maybe 10 or 15% and then forming another base. But it really never, there's really been no wild trade in here that, not much of a reason to sell if you had bought it down in here. So that's the first one. Again, I wouldn't buy that right now. It's extended, but next stock is Applied Materials. This stock I'd been watching while it formed this cup with handle, and I got kind of uninterested in it when the handle had corrected quite a bit here. You can see the handle corrected 12% out of a 15% cup with handle. So that's a pretty deep handle, and I was not so interested in it right here, thinking that it was probably broken. And then they had the earnings report. It really didn't do anything. It was unchanged. And this is a good example of how these earnings reports can have a delayed effect, because you can see it start to climb up here. Whether that's a result of the earnings report or the general market is up for debate, but I've seen this before on stocks like Netflix this year, where had an earnings report, didn't really do anything for a couple weeks, and then started climbing higher. And it's a reason I have a rule now that if a stock's been trading sideways for a long time and I'm thinking of selling it, I have to wait till the earnings report, assuming I have a suitable profit cushion, and then give a couple weeks afterwards. If it doesn't move much around the earnings report, give it a couple weeks to see if it starts to move. So anyways, this thing broke out over here, and this was a long handle. It broke out, and then it came back and pulled back here, and then it bounced off the 50-day moving average here, and it had a really powerful breakout day right here. And I believe there was some news about the stock as well. I think there was like an analyst upgrade. So this was a great day, and you can see there was follow-up buying here. All 3 of these days finished at the top of the range. They had heavy volume, and then the thing came back, pulled back here, very orderly on decreasing volume. So this is great. This is looking fantastic so far. And I actually added to my position today because it had this gentle pullback, and now it's moving higher. So this one I like a lot right now. And again, doesn't report earnings until mid-November. Square. Square had a cut base and had a really powerful breakout back here. And then it had this kind of a wild day right here, which I actually will confess I sold it this day, said the breakout failed, and sure enough the thing climbed higher, so I bought it back. And that's okay, but like I said earlier, I've determined that I've been setting my stops too tight and taking too many 3 or 4% losses, where if I would have widened it up a little bit to maybe a 6% stop, I would have ended up with some big winners this year that I didn't get because I was stopped out of them too quickly. So in hindsight, I've actually suspended this failed breakout rule because it's shaken me out too many times of stocks that have then gone up like this. But you can see the stock's moving up nicely. It's had a bunch of up days in a row, and it's kind of slow accumulation here. It's volume's increasing, but it's not crazy. The stock's not getting it's getting a little bit extended here, but not too badly. And You could kind of look at this as a cup with handle. It was just the handle was a little bit higher than normal. But this one's looking nice. Again, earnings aren't due for a month. Stamps.com. This one had this huge gap move here, 36%, very powerful. And you can see that it's held well above the gap here, and it's formed this cup with handle. And it broke out this day here. It had a gap up when it broke out, which is positive, although volume wasn't great that day. But it's just hanging out. It's going sideways, but it broke out of this base. It's kind of hovering around this 220 level, which was the prior high. But for now, it looks okay. And last one is Netflix. Netflix formed this very nice cup with handle here. You can see very symmetric, and it didn't correct a whole lot, 14%. And the handle was about a little over a week, which was nice. And then you can see it had this gap up day here. This was actually a pocket pivot as well. And then it had the breakout from the cup with handle, and then we had follow-up buying today. We had on this day there was an analyst upgrade, which the market has taken as you can see as a good sign. So this one's looking really nice too. So again, those are things I own, not this one. Those are things I own, and just some ideas for you. Okay, moving on to watch list stocks. I'll just share some of the stocks on my watch list. Log Me In. This one I've been watching for a long time. It's formed this really long handle here. You can see it's been almost 3 months long. And it finally is starting to, it came down, it was following this nice trend line. It broke that trend line this week. And I didn't have buying power, so I didn't buy this, but it'd be perfectly fine to buy it here as an early buy point. It came up through the 50-day moving average. It broke that trend line, and it's looking like it's going to go high. It wants to go higher. This one is due to report earnings in a few weeks, though, so that's a little bit discouraging. I don't like to buy too close to the earnings reports. Vertex Pharmaceuticals. This one is forming it's kind of like a double bottom. Maybe not a textbook double bottom if this didn't undercut. The second leg didn't undercut the first one, but it basically looks like a double bottom. And you can see it just came back above the 50-day moving average today in above average volume. So this one, you could use this early buy point right here, or you can wait till this actually isn't an early buy point. This would be the double bottom buy point. Or if you want, you could treat this as a flat base like MarketSmith says and wait till it breaks out to a new high. Splunk, this one had a fairly deep correction here, but nonetheless, it's a decent cup with handle. The handle, it tried to break out here and it failed, and you can see how it's failed a decent amount here. It's not horrible. It's still above the 50-day moving average, and it's only 3% from the buy point, so it's still okay. It's still worth watching. It had this nice gap up day in the base here after the earnings report, so we'll keep an eye on that one. Baba, I bought this right here. I bought it like here and here, and I ended up selling it here because saying the breakout failed, and now it's right back up trading right around that price. So this is called an ascending base. It's a fairly rare pattern that IBD has studied and said is very bullish. You'll see it talked about in Bill O'Neill's book quite a bit when he goes over his model stocks. So again, this is something I found through study and kind of reflection, is that I had set the failed breakout rule is hurting me more than it's helping me, because I've gotten stopped out many times of stocks like this, and then they just bounce right back up, and then they go on to make these really fantastic gains, and I'm missing out on it. But this one's viable right now. It's 1% above the ascending base buy point. and that's been a big winner this year. Facebook, this one's forming a flat base, and it's about ready to break this trend line that I drew right here, and it's only 2% to the buy point, so this one is looking good as well. This has been a good performer for the year. Since this last base, it's up about 50%, maybe not quite 40%. So this is a good one to keep an eye on. Again, this is another one where I would have been really discouraged by this day when it broke below the 50-day moving average. Heavy volume, we had really heavy volume. It closed at the bottom of the range, and then sure enough, within 4 days, it's back to where it was. 5 below I had in my watch list, and it is extended now. It's 6% above the buy point. So I wait till I won't buy more than 5% above the buy point. That's Bill O'Neill and IBD's recommendation. So even though this is a little extended, you could put, if you want to buy, if you like this and want to buy it, you could put a limit order to say you want to buy it at around 56.77 or better. So if it does have, let's say Monday it trades down a couple percent, you'll get filled and you'll still get a position. I would probably do that, but I don't have buying power right now. NVMI, this stock I bought this day as it had this fantastic breakout, and I thought this is looking fantastic. Big volume. This is it's a lesser known stock. It's relatively early in its life cycle, I think, and it's had 81 days to consolidate here. That's a long time, 4 months. And sure enough, the thing has this big breakout. It was a gap up day. Makes a new all-time high, huge volume, and then the very next day it's down 7.5% and closes just below the buy point. So again, I sold this day due to a failed breakout, and am now disappointed I didn't hold on to it because it really is okay. And so again, these are just some things that I've looked at and adjusted my sell rules accordingly. And just for kicks, I'm just watching this one. I probably won't trade this, but this stock, Applied Optoelectronics, this had a huge move this year. It was one of the biggest winners of the year. And then it had this huge gap down day, 34%. And it sure looks like this stock, the run is over. So I've been watching this one for a potential shorting opportunity. And there was one up here as it was getting close to the 50-day. You can see that it's come down from there. But I'd really like to see this try to trade above the 50-day a couple times and then fail and then go for a short sale. But I'm not very good at short selling. It's something I would have to study more if I was going to do it. But you can see it's hitting resistance at this red line, the 10-week moving average. So it would be totally fine, I think, to short it right now and set the 10-week moving average as your stop. It's a 6% stop. But I'm just kind of keeping an eye on this one. You can see this huge move from 11 all the way up to 100. And that kind of move is not sustainable forever. So you can see that this sure looks like a turning point here, and this stock could be on its way to a big time correction. And if it does, there'll be some shorting opportunities. Okay, last thing is market analysis. So we already went over some of this earlier, but right now the NASDAQ looks great. I follow the NASDAQ mainly because it's more, most of the stocks I trade and IBD has these growth companies, these newer innovative companies are listed on the NASDAQ. But you can see the 50-day moving average still rising, and the stocks traded above it basically ever since the election back here. And you can see we're getting a little bit extended right now. When the stock, when there tends to get a little bit of daylight here, about 3, 4, 5% daylight, it tends to mark a short-term top. So something I keep an eye on is the daylight here between the 50-day and the NASDAQ, because if it gets to be too much, then what'll either happen is like this, where it'll trade sideways for a few months, or you'll get one of these days like this where everything gets whacked. So given this 3, 4, 5, 6, 7, 8 or 9 up days in a row here, we're about due for a down day pretty soon, and so just something to keep an eye on. I'd say if this goes up a couple more percent next week, it would be a good time to reduce some exposure. Okay, so if you found this video on YouTube and you're not a member of this meetup group, then you can join by following the below link. You do need a free meetup account, which only takes a few minutes to set up. And notifications of new videos are only sent out to members, so if you want to receive those notifications, you have to be a member of the group. And occasionally I do distribute files like cheat sheets and that to members, which you can't get unless you're a member of the group. So a few incentives to joining the group. Plus you can interact with other members if you so choose, and you'll learn about any in-person meetups or webinar-based meetups that our group has periodically. There were no member questions from last month. And in summary, for the next presentation, I'm going to talk about sell rules and things to think about to evaluate what kind of sell rules should you have, which ones are appropriate for you, and talking about some different example sell rules. And it's something I've been really working on a lot this year, so hopefully there'll be a lot of value there. So if you have a suggestion for a future topic or any questions, just send me a message on Meetup, and I answer all my emails there. And then if you email me a question, I'll include the answer in the next video. So thank you and happy trading. I'll see you in November around Thanksgiving time.